Picture this. You've shifted to working from home, right? Maybe you've set up this great dedicated workspace, or maybe it's just a corner of the dining room table. And you start hearing about the home office deduction. You're thinking, okay, maybe some tax savings here.
Yeah, that sounds appealing.
But then almost immediately you hear the warnings. Oh, it's super complicated, or careful, that's a huge audit trigger.
Right, the classic fear factor.
Right, exactly. And suddenly that potential saving feels like it might just be a massive headache waiting to happen.
It's such a common feeling, isn't it? Especially, over the last few years with so many people working remotely.
For sure. And the tax rules around using your home for business, well, they can feel like trying to find your way through a maze. Very specific rules, definitions.
Yeah, our source material really hammers that home. I mean, the potential savings are real, absolutely, for people who genuinely qualify. But the pitfalls, if you don't follow those intricate rules, they're just as real, just as significant.
Exactly. And that's really what we want to untangle for you today. This is our deep dive into the complexity around the U.S. home office tax deduction. We're looking mainly at the 2024 tax year, as people are getting ready to file soon, but also keeping an eye on 2025 and maybe even what could happen in 2026.
Right. And we've pulled together a pretty solid stack of sources for this. We've got the official IRS instructions for Form 8829. That's the actual form you use.
Okay.
We've also looked at several expert tax articles, the ones that break down the rules, point out common mistakes, offer some strategy tips.
Good stuff.
And we even found a useful discussion on a tax form, kind of touching on real-world questions, especially about W-2 employees.
That's a big one. So our goal here, our mission for you listening, is to really cut through all that noise, give you that sort of shortcut to being well-informed.
Yeah, exactly.
Yeah.
We want to break down who qualifies right now and, just as importantly, who doesn't qualify currently.
Explain those really strict requirements you absolutely have to meet.
Walk through the different ways to calculate the deduction, the methods, and maybe why you'd pick one over the other.
And tackle some of those potential surprises, like depreciation recapture.
Definitely got to cover that. And, of course, address that big elephant in the room, the audit myth. Does it really hold water?
And all of this is coming straight from the source materials we reviewed, the IRS docs, the expert articles, the forum discussion.
Yep, straight from the sources.
Okay, so let's dive in. Where do we start? I guess the most fundamental question is, who is this deduction actually for? Because it sounds like there's a lot of confusion out there.
That is absolutely the critical starting point. It's where so many people get tripped up right away. And the sources we looked at, crystal clear on this.
Okay, lay it on us.
At the federal level right now, for tax years 2024 and 2025, the home office deduction is primarily for self-employed individuals. Think independent contractors, freelancers, business owners.
People operating their own business out of their home.
Exactly. People who file a Schedule C with their tax return to report their business income and expenses. That's the main group.
Okay, so sole proprietors, freelancers, small business owners running things from home. That makes sense. But what about that huge group of people who work remotely for a company, W-2 employees?
Ah, yes. The W-2 crowd. This is where the current tax law often brings, disappointing news.
Uh-oh.
One of the big changes from the Tax Cuts and Jobs Act, the TCJA back in 2017, was that it got rid of the deduction for unreimbursed employee business expenses. For federal taxes, anyway.
And the home office deduction for employees fell into that category.
It did. So that change started in 2018, and it runs all the way through the end of 2025.
So translate that for us. If I'm a W-2 employee right now working from home full-time, got my dedicated space, no federal deduction.
Under current federal law, for your 2024 or 2025 tax return, no. You cannot claim a federal home office deduction. The expert articles really emphasize this. It's a super common misunderstanding.
Wow, okay. That clears up a lot of the confusion then. So for the next couple of tax seasons, federally, W-2 folks are out of luck on this specific deduction.
Federally speaking, yes.
But you mentioned the TCJA changes are set to expire. End of 2025. Right?
That's the current situation, yeah. December 31st, 2025. And that tax form discussion we saw, it touched on this potential future shift.
So what happens if those provisions do expire?
Well, if Congress doesn't act to extend them or change things, then the rules could revert. the deduction for unreimbursed employee business expenses, which includes the employee home office deduction, it could potentially become available again.
Starting with the 2026 tax year.
Potentially, yes, starting in 2026. Now, it's not a guarantee, obviously. Congress could always step in. But under the law, as it stands today, that's the trajectory.
Interesting. Okay.
Yeah.
And how did that deduction even work for employees back, before TCJA? Was it simple?
Not exactly simple, no. The Reddit thread gave some good context. Before TCJA, it was considered a miscellaneous itemized deduction.
Okay, and what did that mean practically?
It meant hurdles. First, you could only deduct the amount of these miscellaneous itemized deductions that was more than 2% of your adjusted gross income, your AGI.
Your AGI?
Yeah.
That's like your gross income minus certain specific deductions.
Right. Things like traditional IRA contributions, student loan interest. You had that 2% floor to get over first.
And then?
And then you only actually got a tax benefit if your total itemized deductions, including whatever home office amount cleared, the 2% hurdle were higher than the standard deduction amount for that year.
So even when it existed, it wasn't a sure thing. You had to clear the 2% AGI threshold, and you had to itemize, and your total itemized had to beat the standard deduction.
Exactly. It wasn't just a straightforward write-off for every employee working from home. It really depended on your income, your other deductions, whether you itemized.
Got it. Okay.
Right.
So let's pivot back to who can claim it now. The self-employed business owners for 2024 and 2025. Even for them, the IRS has some pretty strict requirements, right?
Yeah.
What are the absolute must-haves?
Yes, incredibly strict. And the sources are absolutely unified on this. For almost all situations, you have to pass 2 fundamental tests for the space you want to deduct.
2 tests. What are they?
They are the regular use test and the exclusive use test. And generally, you need to meet both for the specific area you claim.
Okay, let's break those down. Regular use. What does the IRS mean by regular?
Regular use means you're using that specific part of your home for your business consistently on an ongoing basis. It can't be just, occasional or sporadic use.
So not just once in a blue moon.
Right. An expert article gave a good contrast. Using a spare bedroom sometimes for business tasks, but it's mainly guest storage. That probably fails regular use. The business use needs to be, regular, consistent.
Okay, that makes sense. Now, exclusive use. This one always sounds like the really tough one.
It is incredibly strict, and honestly, this is where a lot of people, even self-employed folks who qualify otherwise, can easily mess up.
So what does exclusive mean to the IRS?
It means that the specific identifiable space you claim as your home office must be used only for your trade or business, period. Any significant non-business activity in that exact space can kill the deduction for that area.
Okay, examples help here. Give us some clear ones from the sources.
All right. Let's say you have a spare room. You use it only as your office. Client calls, bookkeeping, writing reports, all your admin stuff happens there, nothing else. That could qualify, assuming you meet the other tests.
But what about, the reality for lots of people? Working from the kitchen table, desk in the corner of the living room, or in the guest room.
Generally, based on the sources and the IRS instructions, those scenarios do not qualify under the exclusive use rule.
Why not?
Because if you're working at the kitchen table where you also eat meals, or your desk is in the main family room, or the kids' playroom, or your workout space, or, importantly, a room used for overnight guests, that specific area fails exclusive use.
Any personal use at all.
One source put it very bluntly. Any kind of non-business use of that supposed dedicated space can invalidate the deduction for that specific area. It has to be solely for business.
So if my home office is set up in a spare bedroom, but I have a sofa bed in there, and my parents sleep on it for a week when they visit each year, does that blow the deduction for the whole year for that room?
Based on the strict interpretation in the sources, yes, that's exactly the kind of thing that would likely cause that space to fail the exclusive use test for the entire tax year.
Wow.
The space really needs to be dedicated only to business, and the expert articles also mention what auditors might look for. They suggest being careful about what's in the space.
Like what?
Like, a dartboard, a big stereo system not used for work, exercise gear, lots of personal photos or decorations, things that clearly suggest personal use.
So the advice is?
To be safest, move anything suggesting personal use out of the dedicated space you plan to claim. Make it look and function exclusively like a business space.
Okay, so regular use and super strict exclusive use are the bedrock requirements.
Got it. Now, beyond that, how do self-employed people qualify the purpose of the office? It has to be their main place of business, right?
That's the primary way, yes. Meeting the principal place of business test. Your home office needs to be the main hub, the headquarters for your business activities. Form 88829 instructions really dig into this.
And how does the IRS decide if your home is your principal place? Is it just where you spend the most hours?
Hours spent is a factor, definitely, but it's not the only one. The IRS considers two main things. First, the relative importance of the activities you perform at each business location.
Okay.
And second, the amount of time you spend at each location. For a lot of service businesses, that importance of activities test is really key.
And didn't the sources mention a specific rule about administrative or management work?
Yes. This is a crucial clarification in the IRS instructions. It helps a lot of people who might spend time outside the home, like meeting clients or doing work on site.
How does that work? Your home office will qualify as your principal place of business if you meet all these conditions. 1, you use it exclusively and regularly for administrative or management activities for your business.
Like bookkeeping, scheduling, planning.
Exactly. Billing, keeping records, ordering supplies, setting appointments, writing reports. The IRS lists these as examples.
Okay, condition 1, exclusive and regular use for admin management. What else?
Condition 2, you have no other fixed location where you conduct substantial administrative or management activities for that same business.
No other fixed location for substantial admin work. Okay, so let's test this. Say I'm a consultant. I meet clients at their offices maybe 10 hours a week. But all my actual proposal writing, billing, record-keeping, marketing calls, all that happens in my dedicated home office. Could that qualify?
Based on the IRS guidance, yes, that sounds like it likely could qualify as your principal place of business under that admin management activities rule.
Even though I spend time out meeting clients?
Yes, because the essential administrative and management functions happen at home, and you don't have another office space somewhere else where you do those same kinds of substantial admin tasks.
What if I, hire a virtual assistant who does some admin work from their own location? Does that mess it up?
No, the instructions specifically say that having others perform admin tasks elsewhere doesn't disqualify your home office.
Okay. What about doing some admin on the go, like checking email on my phone or working on a report in a hotel room when traveling?
Also fine, according to the instructions. Conducting admin in non-fixed locations doesn't disqualify your home office. Even occasionally doing minimal admin outside the home is okay.
And the big one.
Yeah.
Doing substantial non-administrative work outside the home, like if I'm a plumber and I'm out on calls all day, or a therapist seeing clients elsewhere.
That also doesn't prevent your home office from being your principal place of business if that home office is where you handle your billing, scheduling, record keeping, etc., and you don't have another fixed spot for those admin tasks.
So it really hinges on where the core administrative or management work gets done, assuming there isn't another fixed office for that stuff.
That's the key takeaway for that pathway. It provides a way for many people whose work takes them outside the home to still potentially qualify.
That's much clearer. Okay, so the main path is regular use, exclusive use, and principal place of business, often via that admin management test. But you mentioned a couple of exceptions to the really strict exclusive use rule.
Yes, there are 2 specific situations laid out in the rules where a space can qualify based on regular use, even if it's also used personally sometimes. Exclusive use isn't required in these 2 narrow cases.
What's the first exception?
The first one is for storage of inventory or product samples.
Okay.
If your home is the only fixed location for your retail or wholesale business, meaning you don't have a separate shop or warehouse or anything off-site, you can deduct the expenses for the part of your home you use regularly to store your inventory or samples.
And that storage space doesn't have to be exclusively used for inventory.
Correct. For this specific exception, regular use for storage is enough. Maybe it's a section of your basement or garage where you keep your products, even if the rest of the area has personal stuff.
So if I sell handmade jewelry online and I keep all my beads, findings, and finished pieces in shelves in a corner of my basement, that corner could qualify for a deduction even if the rest of the basement is a rec room.
Potentially, yes. As long as your home is your only fixed business location and you use that corner regularly for storing the inventory.
Anything tricky about calculating that?
Yes. One important note from the Form 8829 instructions. The square footage used only for inventory storage should not be included in the general business percentage you calculate for other indirect home expenses like utilities or mortgage interest. Inventory costs themselves are handled differently, usually as cost of goods sold on your Schedule C.
Ah, okay. Good distinction. So inventory storage is exception number 1. What's number 2?
The second exception is for daycare facilities.
Okay, people running a daycare from home.
Exactly. If you use part of your home to provide daycare for children, or for adults aged 65 plus, say, or for individuals with disabilities, and you meet the state or local licensing, certification, or exemption requirements, you can deduct expenses for the space used regularly for daycare.
Even if that space is used for personal living at other times, like the living room where the kids play.
Yes. Even if it's also your family living room in the evenings or on weekends, the portion used regularly for license-certified daycare can qualify. Exclusive use isn't required here either.
How do you figure out the deduction for a space used for both daycare and personal life?
This gets a bit specific. The Form 8829 instructions have a special computation just for daycare providers. It gets particularly detailed if you have some space used exclusively for daycare, maybe a small office area, and other space used for both daycare and personal use, like the playroom or kitchen.
So you treat the different areas differently.
Kind of. You figure out the business percentage for any exclusively used daycare space in the normal way, based on square footage. But for the space used part-time for daycare, you have to calculate a percentage based on the amount of time it's used for daycare compared to the total time available.
A time-based calculation, how does that work?
You need to track and report the total number of hours the home was actually used for daycare during the entire year. The instructions give an example. Say, Monday to Friday, 12 hours a day for 250 days, plus maybe 50 Saturdays at 8 hours a day. You add all that up.
Okay, so that's your total business hours.
Right. Then you divide those total business hours by the total number of hours in the year, which is 8,760 usually, or 8,784 in a leap year. That gives you the business use percentage for those shared spaces.
And if you only ran the daycare for part of the year?
You'd need to prorate the calculation based on the days you were actually open and operating the daycare. It requires careful tracking of hours.
Definitely sounds like detailed record keeping is needed there. Okay, so the two exceptions to exclusive use: inventory storage, if it's your only location, and licensed certified daycare. Both need regular use.
Correct.
We've covered who qualifies, the strict tests. Now let's get into the nuts and bolts, actually calculating the deduction amount. The sources mentioned two main ways to do this.
That's right. Once you know you qualify, you generally have two options for figuring out the dollar amount of your deduction: the regular method and the simplified method.
Okay, let's start with the easy one, hopefully, the simplified method.
It's definitely designed to be simpler, yes. It's often called a safe harbor method because it drastically cuts down on the record keeping needed.
How does it work?
Pretty straightforward. You measure the square footage of the part of your home that meets all the qualification tests we just talked about. Exclusive use, unless an exception applies. Regular use, principal place of business, etc.
And then what? Is there a rate?
Yes, there is a flat rate set by the IRS. It's $5 per square foot.
$5 a square foot. Is there a limit to how much space you can claim this way?
Yes, there is. The simplified method has a maximum area limit of 300 square feet.
Okay, 300 square feet max. So doing the math, the maximum possible deduction you could get using the simplified method is?
$5 times 300 square feet. That comes out to $1,500 per year. That's the absolute ceiling for this method.
$1,500 max. That seems potentially low if you have a large office or high home costs.
Yeah.
What's the trade-off for this simplicity?
The main trade-off is exactly that. If you choose the simplified method, that $5 per square foot, up to $1,500, is all you can deduct for the business use of your home.
Meaning
You cannot also deduct a percentage of your actual home operating expenses. No separate deduction for a portion of your utilities, your homeowner's insurance, general home repairs, mortgage interest, or real estate taxes related to the business space. That $1,500 maximum is intended to cover all of those things.
Ah, okay. So you give up deducting actual expenses for the ease of just multiplying square footage by $5.
Exactly. You trade potentially higher deductions for significantly less hassle and record keeping.
But one of the sources highlighted a pretty major advantage of the simplified method, specifically when you eventually sell your house.
Yes, and this is a really key strategic point that the expert articles emphasized. A huge benefit of the simplified method is no depreciation recapture.
Explain that. Why is that a big deal?
Because the simplified method uses that flat rate, you're not technically claiming depreciation on the home itself each year. Depreciation is a deduction you can take under the regular method, which we'll get to. But claiming depreciation leads to this recapture issue when you sell. Basically, having to pay tax back on the depreciation you claimed.
So using the simplified method avoids that future tax headache.
Correct. Since no depreciation is claimed, there's nothing to recapture when you sell the home. This is a major plus for the simplified method, especially for people who might sell their home relatively soon. This method was introduced starting back in the 2013 tax year, by the way.
Okay, simplified method recap. Easy calculation, 5 FCL fee capped at 300 ex-QO feet, $1,500 max deduction, covers all home expenses, no complex record keeping for utilities, etc., and crucially, no depreciation recapture when you sell.
It's a good summary.
All right, now let's tackle the other option, the regular method. This sounds like where the complexity really ramps up.
It definitely does. The regular method typically requires much more effort and detailed records, but it often results in a significantly higher deduction than the $1,500 simplified cap.
Especially if you have a larger home office or high home costs like mortgage interest, property taxes, utilities, or maybe expensive repairs just for the office space.
Exactly. In those cases, the regular method might be much more beneficial financially, but it means using Form 8829, expenses for business use of your home, and tracking a lot more information.
Okay, so how do you start with Form 8829? What's the first step?
The first main step on the form is calculating your business percentage of the home. Usually, this is pretty straightforward. You divide the square footage of your dedicated business space by the total square footage of your entire home.
Simple ratio.
Yeah, lines 1 through 7 on the form walk you through that. Unless, of course, you're using that special calculation for daycare facilities we talked about with the time-based percentage for shared spaces, that would determine your business percentage in that specific case.
Okay, once you have that business percentage, say it's 15% or something, what next on the form?
Next, Form 8829 makes you figure out an important income limitation. Your home office deduction generally can't exceed the gross income you earn from the business activities conducted in your home.
So the deduction can't create or increase a business loss beyond what the home-based activities generated.
Pretty much. Part 2 of the form, starting around line 8, deals with this. You need to figure out your business's gross income, and specifically the portion attributable to the use of your home office if you also earn income elsewhere, like out meeting clients.
How do you figure that out if you earn income both inside and outside the home?
The instructions suggest allocating based on factors like the time spent working in each location. It can require some reasonable estimation. From that home-based gross income, you subtract your other regular business expenses, supplies, advertising, etc., that aren't related to the home itself. What's left is your income limit for the home office deduction for that year.
Okay, that makes sense as a ceiling. Then you start listing the actual home expenses.
Yes. The form divides expenses into 2 main columns. A, direct expenses, and B, indirect expenses.
Direct versus indirect, what's the difference?
Direct expenses are costs that benefit only the business part of your home. Think painting just the office, repairing something only in the office, maybe installing a dedicated business phone line only serving the office. You deduct 100% of these direct costs in column A.
Makes sense. And indirect.
Indirect expenses are costs for keeping up and running your entire home. This is where things like utilities, electricity, gas, water, homeowners insurance, security system fees, general home repairs like fixing the roof or the main furnace, mortgage interest, and real estate taxes come in.
And for those, you deduct the business percentage.
Generally, yes. You usually list the total amount of the indirect expense in column B, and then the form applies your business percentage from line 7 to figure out the deductible portion.
Okay. But you mentioned earlier that things like mortgage interest and real estate taxes get complicated because they can also be personal deductions.
Yeah.
How does the form handle that?
Yes. This is where the regular method requires serious attention to detail. Lines 9 through 22 on Form 8829 cover these very expenses, and the instructions for lines like mortgage interest, line 10 or 16, and real estate taxes, line 11 or 17, are quite involved.
Why so complicated?
Because the IRS wants to make sure you're coordinating these deductions correctly with your personal tax situation, Schedule A, itemized deductions versus standard deduction, and not bypassing limitations like the mortgage interest limits from Pub 936 or the $10,000 state and local tax assault cap.
So you can't just slap the business percentage on your total mortgage interest and call it a day.
Not quite. For example, with mortgage interest, the instructions say you first figure out how much would be deductible personally, subject to limits. If you itemize deductions on Schedule A, you typically put the business percentage of that potentially deductible amount on line 10 of Form 8829. But if you take the standard deduction personally, then all the qualified mortgage interest paid for the business home goes on to a different line, line 16, where the business percentage is applied.
Wow. Okay, so whether you itemize or take the standard deduction changes where you even put the expense on Form 8829.
Yes. And there are further rules about excess mortgage interest, beyond personal limits, that might go on line 16 even if you itemize. The instructions even give an example calculation. It's detailed. The sources strongly warn against claiming mortgage interest as a direct expense, even for a separate structure, because of how the personal limits work.
Okay, that sounds like something to read very carefully or get help with. What about real estate taxes? Similar complexity.
Very similar interaction with personal deductions and limits. Again, it depends if you itemize or take the standard deduction, and critically, it interacts with the $10,000 SALT cap.
The SALT cap limits total state and local tax deductions on Schedule A.
Right. So if your total state and local taxes, including property taxes, are $10,000 or less, $5,000 if married filing separately, and you itemize, you typically include the business percentage of your home's real estate taxes on line 11 of Form 8829.
But if your total sold is over the $10 K cap,
then it gets more complex. The instructions have a worksheet specifically for this situation to calculate how much, if any, of the real estate taxes can go on line 11, business portion of the personally deductible amount, and how much might go on line 17, business portion of taxes not deductible personally due to the cap.
and if you take the standard deduction personally.
Then, similar to mortgage interest, all the real estate taxes paid for the business home go directly onto line 17, where the business percentage is applied, not line 11.
Okay, definitely need the instructions or software for those. What about simpler things like rent?
Rent is easier. If you rent your home, you include the rent paid on line 19, column B, for indirect expenses. The form applies the business percentage, though the instructions note you can't deduct rental value if your housing is provided tax-free.
Good. And other general operating costs, like basic utilities, cleaning.
Those usually go on line 22, other expenses. Things like electricity, gas, water, trash removal, general cleaning supplies or services for the whole house, the business percentage applies.
What if you couldn't deduct all your expenses last year because of that income limitation? Can you carry them over?
Yes, that's an important point. Form 8829 allows for carryovers. Unallowed operating expenses, like utilities, insurance, repairs, rent from the prior year's calculation, specifically from line 43 of the 2023 Form 8829, can be carried forward and added on line 25 of the current year's form.
So you don't necessarily lose those deductions forever.
Not the operating expenses, no. They carry forward until you have enough business income from the home office to deduct them. The instructions even mention how to handle carryovers if you use the simplified method in the previous year, but had carryovers from an earlier year when you use the regular method.
Okay, that's good to know. Now, the other big piece of the regular method is depreciation, right? Part 3 of the form.
Yes, depreciation is often a significant part of the deduction under the regular method, but it also adds complexity and leads to that recapture issue we discussed.
How do you calculate on Form 8829?
First, you need your home's basis for depreciation. Lines 3740 handle this. You generally start with the cost of the home, or its fair market value when you first started using it for business, if that was lower. You have to subtract the value of the land, line 38, because land isn't depreciable.
So you're depreciating the building, not the land.
Correct. The result is your depreciable basis for the building, line 40. Note that major additions or improvements you make after you start using the home for business are handled separately. Their cost isn't included here on lines 3740.
Okay, you have the basis of the building, then what?
Then you need to find the correct depreciation percentage to use, line 41. This percentage depends on when you first started using your home for business.
Where do you find that percentage?
The Form 8829 instructions provide tables. If you first used your home for business in 2024, there's a table showing the percentage based on the month you started. If you started using it before 2024, you generally use a standard percentage for most homes first used for business after May 12, 1993, and before 2024, the rate is typically 2.564%.
Okay, a standard rate for most ongoing users.
Usually, yes. There are notes about specific older situations, or if you stop business use mid-year, you might need publication 946. Interestingly, if you use the simplified method last year, say 2023, but switch back to regular this year, you still use the standard percentage based on when you originally started business use. For example, 2.564% if you first started in 2022 or 2023.
Got it. So you multiply the basis, line 40, by the business use percentage, line 7, and then by the depreciation percentage, line 41.
Almost. You multiply the business basis, which is line 40, multiplied by your business use percentage from line 7, by the depreciation percentage from the table, line 41. That gives you your depreciation deduction for the home itself, line 42.
And what about those later additions or improvements you mentioned?
Depreciation for those is calculated separately. You use the appropriate depreciation percentage based on when they were placed in service, and you have to attach a statement showing that calculation, according to the instructions.
Do you need to file any other forms for depreciation, like Form 4562?
Good question. You only need to file Form 45662, Depreciation and Amortization, for your home office depreciation if you first started using your home for business in the current tax year, 2024, or if you are depreciating additions or improvements placed in service in 2024.
So if you've been claiming it for years, no separate Form 4562 needed, just for the home itself.
Correct, for the home itself. If you do need to file Form 4562 because it's the first year or for new improvements, you report the details on line 19I of that form. But crucially, the depreciation amount calculated on Form 8829, line 42, does not get entered again on Schedule C, line 13 depreciation. Form 8829 handles it.
Okay. And just like operating expenses, can depreciation also be limited by income and carried over?
Yes. Depreciation, along with any deductible casualty losses related to the home office, which are calculated separately using Form 4684 principles and other complex area detailed on lines 9 and 29, are subject to the overall income limit. Any amount you can't deduct in the current year because of the limit gets carried over to the next year.
Where does that carryover show up?
Unallowed depreciation and casualty losses from the prior year, this is Anna from line 44 of 2023, Form 8829, are brought forward onto line 31 of the current year's form. Again, there are rules if you use the simplified method in between.
Phew. Okay, so the regular method is definitely regular work. Let's quickly summarize the two methods again.
Sure. Simplified method. $5 per square foot, max 300 SQFT, $1,500 deduction cap. Super simple, no tracking of actual expenses needed, and crucially, no depreciation recapture when you sell. Regular method. Uses Form 8829. Calculates your business percentage of actual home expenses, utilities, insurance, repairs, rent, plus depreciation on the home's basis. Requires detailed records, navigates complex rules for mortgage interest taxes, often yields a higher deduction, but does involve calculating depreciation and leads to depreciation recapture tax when you sell.
And the advice from sources is often to calculate both if you might qualify for regular, see which is better, but weigh that against the record-keeping burden and that recapture issue.
Exactly. You have to consider the immediate tax savings versus the long-term implications and the effort involved.
Let's really underline that recapture problem again. It seems like a major hidden cost of the regular method.
It absolutely is, and it's highlighted in the sources as a common, nasty surprise people forget about.
So normally, selling your main home, you get that big capital gains exclusion, right? $250K single, $500K married.
Correct. That's the general rule for your primary residence, assuming you meet the ownership and use tests. Huge tax break.
But if you use the regular method for a home office,
then any depreciation you claimed over the years using that regular method, the IRS wants it back when you sell. It gets recaptured.
meaning you pay tax on that amount.
Yes. A portion of your gain from the sale equal to the total depreciation you claimed is taxed. And importantly, it's generally taxed at ordinary income rates, up to a special maximum rate of 25% for this type of recapture, not necessarily the lower long-term capital gains rates.
So even if the rest of your gain is tax-free under the home sale exclusion, the part equal to the depreciation claimed gets taxed.
Precisely. If you claimed, say, $10,000 in depreciation over the years via the regular method, when you sell, roughly the first $10,000 of your profit could be subject to that recapture tax.
Ouch. And this is where the simplified method shines for simplicity upon sale.
Exactly. No depreciation claimed means no depreciation to recapture. It's a much cleaner break when you sell the house. It's a huge factor in deciding which method to use long-term.
Definitely something everyone using the regular method needs to have on their radar. Okay, let's switch gears and tackle that other big cloud hanging over this deduction. The audit myth. Is claiming the home office deduction truly an automatic red flag for the IRS?
Based on the sources we looked at, the consensus is it's largely a myth. Several sources directly address this, calling it a myth or listing fear of audits as a reason people wrongly avoid a legitimate deduction.
So why is the fear so persistent? Where did that bad reputation come from?
History plays a role. One source explained that back after the rules were formalized in the 70s, Section 280A, there was a lot of misunderstanding and, frankly, improper claiming of the deduction.
People claiming it when they didn't really qualify.
Yeah. That led to increased IRS scrutiny back then, and a lot of people had to pay back the taxes. That history kind of stuck, creating this lingering feeling that it's inherently risky.
But things are different now. How does the IRS select returns for audit today?
The IRS uses complex computer algorithms, primarily the discriminant information function, or DIF system. DIF scores returns based on how much they deviate from statistical norms for similar taxpayers' people in your profession at your income level.
So it's looking at the whole picture.
Exactly. It flags returns with significant inconsistencies or unusually large deductions compared to the averages. The home office deduction is just one data point among many that the system considers. A very large overall deduction total relative to your income, or numbers that just don't seem to add up, are generally more likely to catch attention than the home office deduction itself, provided it seems reasonable for your type of business.
So the key takeaway from the sources is,
if you genuinely qualify, you meet those strict tests: exclusive use, regular use, principal place of business, or an exception, and you keep excellent records to back it all up, you generally shouldn't fear an audit just because you claim this deduction.
an audit isn't punishment, it's just verification.
Right. If you get examined, they'll just want to see proof that you meet the criteria in the tax code and the Form 8829 instructions.
What kind of proof or records do the sources recommend keeping, besides the expense receipts?
Good question. Beyond the financial records, utility bills, insurance, mortgage statements, tax bills, repair receipts, they suggest documenting the qualification itself. Things like a clear calculation of your square footage, maybe a floor plan showing the dedicated space, evidence of it being your principal place of business, and crucially, proof of exclusive use.
How do you prove exclusive use?
One expert source had a great suggestion. Take dated photographs or even a video walkthrough of your dedicated workspace each year. This serves as documentation of its condition, its contents, and its exclusive business setup during the tax year, especially helpful if you move or reconfigure the space later.
That's smart. So the bottom line on the audit myth: don't be scared off from a legitimate deduction, but do be prepared. Qualify properly. Keep meticulous records.
That's the message. Compliance and documentation are your best friends here. Claim it confidently if you meet the rules and can prove it.
Okay. Now, we established early on that W-2 employees are generally out of luck for the federal deduction in 2024 and 2025. Are there any other avenues for them to recoup some work-from-home costs, according to the sources?
Yes, the articles did touch on a couple of other possibilities, though they aren't federal tax deductions for the employee.
Like what?
The main one is employer reimbursements. Especially since remote work became more common, many companies have put policies in place to reimburse employees for necessary home office equipment or supplies.
How does that work tax-wise for the employee? Is that reimbursement considered income?
It usually isn't taxable income if the employer has what the IRS calls an accountable plan.
Accountable plan. What's that?
It's basically a formal company policy that meets IRS requirements. It generally means employees have to adequately account for their expenses, provide receipts or proof of payment, and they have to return any excess reimbursement they didn't actually spend on business needs. If the plan follows those rules, the reimbursement is tax-free to the employee.
And if the company doesn't have an accountable plan?
Then the reimbursement might be treated as taxable wages, unfortunately.
Are companies legally required to reimburse these costs?
Federally, not usually. There's no general federal law mandating reimbursement unless the unreimbursed expenses would illegally drop the employee's effective pay below minimum wage.
But what about state laws?
Good point. Some sources noted that state laws can differ. One mentioned that 11 states do have laws requiring employers to reimburse employees for necessary business expenses. Work from home costs might fall under those state rules, depending on the specifics. So state law is definitely a factor.
And is reimbursement common, even if not legally required?
Seems to be fairly common. One source, SHRM, cited that 56% of companies offered reimbursement for work equipment in 2024. So it's worth asking your employer about their policy.
Any downsides to getting reimbursed for, say, a computer monitor or a desk?
One expert pointed out something practical. If your employer pays for the equipment, they likely retain ownership of it. So if you leave the company, you might have to give that monitor or desk back.
Good point. Okay, employer reimbursement is one avenue. What else?
The other crucial reminder is state taxes.
Right, state rules can be different.
Exactly. Even though W-2 employees can't take the federal home office deduction right now, some states might still allow employees to deduct certain unreimbursed work-from-home expenses on their state income tax return.
So you need to check your specific state's rules.
Absolutely. State tax laws vary widely. Don't assume the federal rules apply. Check your state's tax department website or talk to a tax pro licensed in your state to see if any state-level deductions are available for employee home office costs.
Okay, that's a really important distinction. Federal rules aren't the only game in town.
Definitely not. Always check state rules, too.
This has been incredibly thorough. We've really unpacked the home office deduction using these sources. We tackled the audit myth, basically. Be compliant, keep records, don't worry unnecessarily.
Yeah.
And we covered alternatives for employees, like employer reimbursements under accountable plans and the possibility of state-level deductions.
It really covers a lot of ground. It's clear that while the deduction offers real benefits, it's definitely not just a simple line item on a tax return for most people who use the regular method.
No, it demands real attention to the rules and very diligent record keeping.
Absolutely. So as you're thinking about your own situation, maybe you're self-employed looking at this year's taxes, or maybe you're an employee wondering about 2026, really look hard at those core tests.
Is the space truly used only for business?
Is it used regularly?
Does it meet that principal place of business test, considering where you do your admin work?
And then weigh the calculation methods. Is the $1,500 cap and simplicity of the simplified method plus avoiding recapture good enough for you?
Or is the potentially bigger deduction from the regular method worth the hassle? Tracking all the expenses, dealing with the mortgage interest and tax rules, calculating depreciation, and knowing you'll face recapture later.
Yeah, it's a strategic choice, given all that complexity, especially with the regular method and how it ties into your personal tax situation. Is the potential tax saving always worth that extra effort and the risk of mistakes?
Or is a simpler path, maybe the simplified method, or focusing on state deductions or employer reimbursement if you're an employee, is that actually the more practical route for your specific circumstances?
That's really the question to ponder, isn't it? Something definitely to think about as you approach tax time or plan your business finances.
And with that thought, our deep dive into the home office tax deduction concludes. Thanks for exploring the source material with us today.
Always enjoy digging into the details.
We'll see you on the next deep dives.